Welcome to the Deep Dive. We're looking at a mid-October 2025 report today, and honestly, the picture it paints is pretty stark. Think red charts, lots of metaphorical burning money.
Yeah, it's definitely a tough climate out there.
And if you're a long-term crypto holder, you are right in the middle of this volatility.
Absolutely. The numbers really drive it home. Since the peak last October, the total crypto market cap, it shed over, $720 billion?
Wow.
That's a massive figure, and it's not just numbers on a screen, is it? It's a huge psychological weight for anyone watching their investment shrink.
That's exactly it, the emotional side. Let's dig into that because, the source material is pretty clear. Hardly anyone timed the top perfectly.
Oh, definitely not. Trying to catch the absolute peak or the absolute bottom. It's usually futile.
Right. And that constant trying, the micromanaging, it leads to overthinking, panic.
Mm-hmm.
It's precisely where you risk losing out on potential, generational wealth. Turn around.
Yeah, trying to finesse the market during these wild swings is, it's often a recipe for mistakes. You start second guessing, and you're likely to sell at the worst moment or just freeze completely. Paralyzed,
Analysis paralysis, yeah.
Yeah.
So, okay, if you're that long-term holder, maybe feeling a bit nervous, what's the game plan?
Well,
this deep dive today, it isn't about day trading secrets. It's more about a strategic defense for holders, making sure those assets aren't just sitting there.
Exactly. Dead weight.
We're looking at how DeFi, decentralized finance, actually changes the game for holding during these rough patches.
And to really get that, we need to understand the common situation, maybe the trap. The report says most crypto owners aren't active traders.
Right, they're the believers, so long-haul folks.
Precisely. They bought in for the long run, so now they're just holding on through this huge downturn.
So they bought their Bitcoin or ETH, whatever, maybe years ago. They believe in it. Now they're just waiting for the rebound. Is that wrong?
Holding itself isn't wrong, not if you fundamentally believe in the asset's future. But holding without a plan, that's different.
How so?
It's the cost of doing nothing, the opportunity cost. Idle assets are entirely reliant on the price going up. Think of it like having loads of cash in a checking account when inflation's high.
Okay, yeah.
It feels safe, maybe, but it's losing value, it's purchasing power. Every single day, it just sits there.
That's a great way to put it. If the price stays flat or drifts down for another year, that's a year of lost potential if the capital isn't working somehow.
And this is where the report offers a really interesting strategic shift. It suggests using yield generation as a hedge.
A hedge?
Yeah. It calls yield one of the smartest plays long-term holders can make during volatile times or bear markets. It's a mental shift, really.
From waiting to
building, actively building recovery power. The mantra is sort of build, compound, position yourself for recovery, not just wait for it.
Okay, build, compound. I like the sound of that. But let's be real. If my coin is down, say, 50%, how much difference does earning a few percent yield really make?
That's the crucial question.
And isn't putting my already risky coin into some DeFi thing even riskier?
It feels counterintuitive, right?
Yeah.
But this is where compounding yield during low prices gets really powerful. You shift focus from the dollar value, which looks scary now, to the amount of the asset you hold. Volume over value, temporarily. So DeFi turns holding into building by making those idle assets active, mostly through staking.
Okay, staking. Walk us through that simply. For someone who hasn't really explored DeFi, what is it?
At its core, staking means you lock up your crypto assets to help secure the network they run on. Think proof-of-stake blockchains.
Right.
By committing your coins, you're helping validate transactions, keep things running smoothly, and for doing that service, the network rewards you.
Rewards me with?
Usually with more of the same coin you're staking. And importantly, the report notes this can often happen while your assets stay in secure cold storage. You keep control.
Ah, okay. So I'm not giving my coins to someone else to manage. I'm using them to support the network itself and getting paid in return. What kind of return are we talking, roughly?
For established sort of blue chip assets, the report suggests yields typically in the 3 to 8% range annually.
3 to 8%. Okay, still sounds maybe small compared to a 50% drop.
It does, but remember, the yield is paid in more coin. That's the absolute key here.
Okay, I think I'm starting to see it. Let's make this concrete. Let's invent two holders, A and B.
Good idea.
Both bought 100 units of CoinX when it was $100. So $10,000 invested each. Now CoinX tanks. It's down to $40. Those are looking at a $6,000 paper loss.
Right. Holder A is our traditional holder. They've got their 100 coin X sitting in a wallet, just waiting, hoping. They need the price to go up by $60 just to break even.
A long wait? Maybe. But holder B, our savvy DeFi user, they took their 100 coin X and staked it, let's say conservatively, earning 5% yield.
Okay, 5% APY paying out periodically in coin X.
So over, say, 6 months while the price is still low at $40, what happens?
Well, holder B would have earned roughly 2.5 extra coin X from that 5% yield over half a year. They don't have 100 coins anymore. They have 102.5 coin X.
Ah, well, the price is cheap.
Exactly. This is where the report says this isn't magic, it's logical. They're accumulating more units of the asset when units are inexpensive.
So let's fast forward. The market starts recovering. CoinX climbs back to $80, still below their buy-in price, remember?
Right. Holder A, with their original 100 coins, that's now worth $8,000. They're still down $2,000.
So holder B?
Holder B has 102.5 coins at $80 each. That's $8,200.
So they're still down too, but $200 less down than holder A.
Correct. They've cushioned the loss simply by being active. And think longer term, when CoinX finally hits $100 again.
Holder A is back to their initial $10,000, breaking it.
But holder B, with 102.5 coins, is at $10,250. They're actually in profit, thanks to the extra coins earned during the downturn.
That really illustrates it. You're using yield to effectively increase your position size when prices are depressed without spending new money. It changes the whole dynamic.
It turns that dreaded bear market waiting game into an accumulation phase, much more proactive.
Okay, but we need to address the elephant in the room, the risk. You mentioned it earlier.
Absolutely critical.
If I'm trying to play it safe during a drawdown, adding DeFi risk seems scary. What are we talking about practically?
It's a valid concern. Look, the same care you took researching the crypto asset itself, you need to apply that maybe even more intensely to choosing where and how you generate yield in DeFi.
Okay.
Broadly, you're looking at two main risk categories: smart contract risk and protocol risk.
Can you break those down quickly?
Sure. Smart contract risk is about the code. DeFi runs on code, smart contracts. If there's a bug, a flaw, an exploit in that code,
funds can get stolen or locked.
Exactly. It's the tech risk. Protocol risk is more about the specific rules of impermanent loss if you're providing liquidity.
Where the value of your deposited assets can go down relative to just holding them.
Yeah, potentially, depending on price movements. It's complex. So these risks are real.
Which might explain why, as the report notes, fear or lack of education stops many people from trying this yield strategy. Maybe the fear is rational.
The fear is rational, but the answer isn't necessarily just avoiding it altogether. It's about education, better tools, and crucially, better infrastructure.
Okay, infrastructure.
Yeah, the industry knows these are barriers, and there's a lot of work being done to make DeFi safer, more reliable, more professional.
And that's a neat segue into another part of our source material, focusing on that infrastructure, building trust and safety. The report introduces a company called Metallicus.
Right, Metallicus. And their whole focus seems to be precisely on this issue, building a reliable, compliant bridge.
A bridge between what?
Between traditional finance, the regulated banking world, and this new world of decentralized finance and digital assets. They develop blockchain solutions specifically aiming for that intersection.
So they're building the plumbing, basically.
In a way, yes. The report highlights two key things they're behind: the Metal blockchain and something called the Digital Banking Network, or TDBN.
Okay, Metal blockchain and TDBN. How do they fit into making yield strategies safer or easier?
Well, the Metal blockchain is described as being built specifically for financial applications. Think speed, security, but also, importantly, compliance features. Things regulated institutions need.
So not just another general-purpose chain, but one tailored for finance.
That seems to be the idea, creating a space where these financial activities, maybe including sophisticated yield strategies, can happen within a more controlled, compliant environment.
And the TDBN, the Digital Banking Network.
That sounds like the connection piece, linking this specialized blockchain infrastructure back to the existing banking system. The goal is to let banks, institutions, maybe even regular users interact with digital assets and DeFi-like services, but with familiar security and compliance layers.
Interesting. So you've got investors slowly shifting their mindset from just holding to actively compounding.
Right, becoming more strategic.
And at the same time, the underlying technology and infrastructure is maturing to hopefully make doing that safer and more accessible.
That combination is really the key takeaway, I think. It suggests that earning yield during downturns might move from being sort of niche DeFi expert trick to becoming a much more standard part of just holding digital assets long term.
That really changes the outlook, doesn't it? We started this conversation looking at that huge, frankly scary $720 billion market cap drop. But the realization is that volatility isn't just destructive. If you play it right, it's actually an opportunity to accumulate.
If you have a strategy, that's the core lesson, isn't it? Don't just let your assets sit there passively through the storm.
Right.
If you're committed for the long haul, find a way to put those assets to work, generating yield, compounding your holdings, especially while prices are low.
So when the recovery comes,
you emerge stronger with more assets than you started with. It's about maximizing that recovery potential.
And we'll wrap up with a really powerful final thought from the report, tying this all to the bigger picture. It states, the wealth transfer is happening in real time.
Strong words.
Yeah. Happening right now amidst this volatility. The implication being wealth moves away from those paralyzed by fear and towards those who are strategically building.
Building through the downturn.
Exactly. So the question for you, the listener, is your current strategy built for that transfer? Are you actively accumulating or just waiting and hoping? Something to really think about.